The great shift of capital is upon us. This could benefit a wide range of different stocks. This can be like 2021's little cousin. I don't think it's going to be as extreme. I don't think everything's going to do crazy well. I don't think you're going to get stocks that are basically bankrupt companies doing fantastic. No, not at all. But to see a good chunk of the markets do very well, the chunk in which AMC is in do very well, would not surprise me in 2024. So we're going to go over what this great shift of capital is. I'm dubbing this name, so if you guys have a better name for it, let me know down below in the comment section. But I don't think anyone's really talking about this the way that we are going to here in this video. Stocks like AMC actually are exactly what you want to be in for 2023. Now, AMC has its own issues. AMC has a CEO that is delusional, that just doesn't understand how to work a publicly traded company, right? You don't dilute shareholders after you see a small baby rally when you don't need to, right? They're definitely dilution happy and hungry for dilution, apparently. What we're going to talk about here in this video, though, could slow some of that down as well. So ultimately, you could be looking at the Moass here as well. So we're going to go ahead and get into all of this information. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Let me know what you guys think about all of this information. So first things first, and most notably, right? Let's just be honest. Let's give it to you straight before we look at the data here. This great shift of capital is exactly that. It's money moving around. There's a lot of money out there. The money supply hit a high of over $20 trillion. There's still $18.5 trillion out there. But a lot of that money is not in stocks, right? A lot of that money is in bonds. A lot of that money is in cash. A lot of that money is in people's bank accounts, not being deployed into stocks, right? Look at the markets lately. I mean, if you're not in the top 10 largest stocks in the markets, you've probably done pretty dang poorly on an average basis, right? Equal weighted stocks have not done anything in years, okay? When you're talking about a couple of months, that's one thing. But when you're talking about years, a lot of people just up and give up on the markets. So why are you going to see a great shift, capital shift, allocation shift in our markets? It's simple. The Fed has been working against us for almost 2 years now. Well, that's coming to an end. It's clear. Look at the last inflation report. The last CPI report came in 0% month over month. And you're almost back in the twos for headline CPI year over year. It's clear. Inflation is done. The only area that really has inflation anymore is housing, and the Fed just cannot control that. Believe it or not, if the Fed actually lowered rates, they would probably bring down housing inflation quicker because people could build more homes, right? That's the problem. There's just not enough homes being built. That's why on Friday, building permits came in a little bit higher than expectations. The expectation was 1.45 million building permits for the month of October. You came in at 1.48 million building permits, and Russell stocks rallied off of that news. If you are someone that's in the camp that believes inflation is gone, that believes we either skirt by without a recession or get a small recession, this great allocation of capital will greatly benefit stocks like AMC. In my personal opinion, I'm not a financial advisor. I'm not a financial planner. You guys know the spiel. I could be right. I could be wrong. That's not the goal of this video. The goal of this video is to share my opinions and let you guys know what I think. And I'm fully positioned for this. I've been positioned for this for a long time now. Way too long. I should have been in the top 10 biggest stocks out there. But now I think that's where a lot of people's narrative is. But that's probably not where you want to be. You, in all reality, you could actually see money move out of big tech into these areas that we're going to talk about. And the areas are simply quality, small, mid-cap companies, and companies that are very sensitive to interest rates. I think one of the biggest beneficiaries of rates going lower that could see the most capital inflows is a stock like a Tesla, right? High quality, self-funded, 90% of buyers for Teslas finance them. There's no other company that will benefit more from rates going lower in 2024. And right now, the markets are pricing in 3 to 4 rate cuts in 2024. And there's about a 20% chance we get 5 rate cuts in 2024. Let me tell you right now, if that economic data starts to really turn down, well, that 28% chance of a rate cut in March is going to turn into a 50+% chance of a rate cut in March. March 20th, 2024. You have a 28% chance of getting a rate cut, a 72% chance the Fed continues to pause. May 1st is when you're pricing in your first rate cut. Whatever is priced in here in the bond market with the Fed fund futures is what the Fed is going to do, right? So that's where data moves these things around. That's where the CPI report, before that, we were pricing in the first rate cut by like July. And now we're pricing in the first rate cut by May, potentially by March, if we continue to get good inflation data and continue to get weakening economic data. Now, that's the tricky part. This is the trickiest part and the whole caveat of this video. If you go into a recession, well, markets usually panic at that point. It is somewhat backwards looking, though, right? So imagine it like this. By the time you actually go into a recession, you've been in a recession already for about 6 months. That's because a recession is 2 quarters of declining GDP. Well, if 2 quarters, that's 6 months, 3 months per quarter, you're already in the recession. So a lot of the time, the markets will actually freak out and panic when you get that recessionary data, when it looks like you are heading into a recession. So that theoretically could be at some point throughout the rest of this year. That could be the beginning of 2024. Now, there's no telling. There could be a recession in the back half of 2024 or 2025. I think the real question is, how much deflation do we see? How strong is the consumer? And do they continue to spend? As of right now, I just don't see anything that's really derailing that necessarily. You're still seeing, a lot of jobs being added. Things still look fine out there. And most recessions are actually kickstarted by some kind of problem or crisis, right? Whether it's in the bond market, whether it is real estate, like the global financial crisis, and the banking sector and autos, kind of everything toppled to that point. But normally there's some kind of event that causes the actual recession. Usually there's weakness until that event happens. So if you just get weakness and you don't get that event, then you could skate by a recession. Now, you could argue that that event could have been the banking crisis, and that's true, but the Fed injected over $400 billion as soon as that happened, so that looks like it is all but over with at this point. Now, that could obviously come back about, but I think the markets have already seen through that, and I don't think that's really something that is causing or will cause a recession. So as of right now, I'm slightly more in the soft landing camp, believe it or not. Now, with the soft landing camp, I do think there's a chance that even if we don't have a recession in 2024, you could get that delayed recession in 2025. It looks like your late cycle economy. So even if you don't see a recession, it's not like things are going to boom for a while. But you don't need things to boom for a while to see stocks just get back to fair values, right? These stocks that I think will do well have a lot of things in common. Number one, they have in common. You've all heard about them, right? Number two, they've all been improving. Their businesses have not been getting worse. They've been getting better. And number three, they all benefit from rates going lower. And AMC stock fits that category perfectly. Still recovering from pre-pandemic numbers, right? From the Rona. But it's been improving. And, its earnings have been improving. Its actual, state of the company. It will benefit a lot from rates going lower as well. And it is a household name. Everyone knows AMC Theaters. Like, it's been in business for over 100 years. Like, everyone knows. Other companies that fit that bill that I personally invest in are a Fubo, or a SoFi, or a PayPal, right? These companies that are pretty sensitive to whether or not we go into recession, but also improving companies, household names that will benefit from rates going lower. I plan on making a video maybe later on today, maybe on Sunday, of all those companies I mentioned, like 5 different stocks, and all of these stocks could 10 to 50x at some point over the next 10 years. And I do plan on making a video on that, but this is kind of the broad concept. That video might actually come out tonight. We'll have to wait and see exactly. Now, let's look at some of this data here. So first and foremost, money market funds have $5.9 trillion in cash inside of them. This just shows you there's a lot of dry powder on the sidelines. Where's that dry powder going to go when the Fed does start to cut rates? It's not going to go into big tech that benefits from rates going higher. It's not going to go into, terrible companies. Let's be honest. Some of your terrible companies that did well in 2021 are not coming back. And if you hold those, that's unfortunate. But there is a certain sense of quality for our markets. People don't want to invest in just any old company that's not quality, that's not improving, that's not a household well-known name. No, that's not it, right? You don't want to be in those names. That's my personal opinion. That's why I'm saying this is like 2021's little cousin, right? Or little brother, because 2021, everything did well, pretty much. In 2024 or 2025, a lot of things are going to do well, but they're going to be higher quality names. That's a thing. And a stock like AMC could easily 10x in value, right? Just from, a small amount of inflows. Fun fact for you, the Russell 2000, the entire market cap of the Russell 2000 is 2.23 trillion. Huh? That's lower than Apple. That's lower than a Microsoft. That's lower, about 3 times lower than the amount of money in money market funds. Huh? That's insane. So you don't have to see a lot of money go into small and mid-cap stocks to get big moves and big returns. Something like an AMC that is one of the highest weighted stocks of the Russell 2000, is going to see a lot of that money, right? Every dollar that goes into the Russell 2000, a certain percentage of that goes into AMC stock regardless. So I do think that's important. Also, when rates do go down specifically for AMC, maybe they don't need to dilute shareholders as much. Maybe they can get better terms for refinancing some of their debt, and maybe going to the bond market might make a little bit more sense. We've reported on this as of recently, but you have seen investors buying AMC's bonds, right? That's a pretty bullish sign. You usually want to pay attention to the bond market over, what the stock's doing on any given day. And the fact that bond investors are buying AMC's bonds is a pretty good sign. That's usually what you want to see rather than not. So I think that is pretty encouraging as well. And again, it doesn't take a lot of money to move these stocks big time. What's AMC's market cap? 1.5 billion? What if you see 3 billion going to AMC? What if you see 10 billion going to AMC? It's not a lot, right? At the grand scope of the money supply out there, it's not a lot of money, but could have big moves to AMC. Again, the caveat is, if you start to go into recession, markets will panic a little bit, and that could be your ultimate buying opportunity for some of these stocks as well. If we were to get a lot of fear, and let's say AMC went to $5, $4, $3, that's a good buying opportunity right there. SoFi, if that went to same levels, $3, $4, $5 per share, that's a good buying opportunity. If a Fubo went back under $1.50, that's a good buying opportunity, right? If PayPal went to 40, that's a good buying opportunity. If Tesla went to 150, that's a good buying opportunity. I think you're going to make a lot of money on some of those positions. It's just my personal opinion. I will elaborate again more on those stocks in another video. Those are all stocks I think that can do very well over the next 12 months, if not the next 5 to 10 years or so. Could make you a whole lot of money. And they're just improving businesses. That's it. That will benefit from rates going lower. So I don't know the exact timing. I don't know if we'll see a lot of these gains towards the end of 2023. Typically, Wall Street does like to price things in ahead of time. So if we're expecting the first rate cut by May, that means investors are going to be fully positioned in stocks that will benefit from rates going lower by at least February. if we start to expect the first rate cut in March, then people are going to be allocated to those stocks and invested in those stocks that will benefit from rates going lower, probably by December, right? It's usually like 3 months ahead of time. That's why a lot of your, vaccine stocks did well before there was ever a vaccine. That's why something like a Zoom really didn't crash during the Rona. It just went higher because people already knew, like, hey, whoa, there's going to be work from home for who knows how long. We want to buy this stock called Zoom, right? There's a lot of different references to that. Real estate did well. Real estate companies did well, like a Redfin or a Zillow, before real estate even did well, because people knew rates were now at zero and it would do well, right? That's my point. Wall Street prices these things in. So I don't know when exactly that will happen. I think a lot of it comes down to when the first rate cut is going to be, but I know there will be a great shift of capital in our markets, and that could potentially cause the Moass. Yeah, that could be it. A big injection of capital mixed with more optimism on Wall Street. Mix that with some good news for AMC. No more bad news, no more dilution potentially at that point. Lower rates, AMC able to have a little bit more flexibility in their day-to-day operations, their business itself. Maybe the economy does do okay and skirts by without a recession. This could happen by the beginning of 2024. If you're not excited, you need to get excited. If you're not excited, you need to get excited. That's the bottom line, because I think good things are coming. This is a long time in the making, guys. Remember, the Fed's been raising rates for almost 2 years now. It's been a long time. That has been a drain and drag on AMC, on your portfolios for 2 years. Unless you're in just your big tech names that have benefited from rates going higher, which I'm sure a lot of you guys watching this video are not. You have had someone fighting you for 2 years. You're exhausted. You're beaten up. You're down and out. I get it. So am I. So is my portfolio. I'm not down and out. I should say just my portfolio is. I'm ready for the next round. And I'm preparing for that next round now before Wall Street ever figures it out. You got to be ahead of Wall Street in this game. You're competing against the smartest individuals in the world, arguably. Maybe not so much you would think. You'd think the smartest individuals in the world that are managing basically retirements everywhere. You're competing against the smartest computer programs in the world. The only two benefits you have is, one, positioning before Wall Street figures things out, which that's what I'm saying here in this video. Number two, to hold your positions. That's it. A lot of these guys can't hold positions. They can't afford to hold positions, right? That's why a lot of people that invested in like an Apple in like 2000, right, ended up selling their positions and don't hold them today. They don't have the balls of steel to hold these positions, right? And it comes to a certain point where that's why retail tends to have higher returns. They tend to hold on to their positions. They tend to, see things first before Wall Street a lot of the time. So that's just my opinion. Let me know what you guys think about this down below in the comment section. Do you think this could cause the Moass an injection of liquidity into our markets, mixed with investor optimism, mixed with retail investors taking control of the stock again? Not to mention, we're going to have a lot more clarity on what the short positions look like for AMC stock, who is short, why they are short, what kind of collateral they're used to be short, what is the prime broker facilitating these trades. All of that information, we will get a lot more of it coming at the end of November. So let me know what you guys think about this down below in the comment section. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.